Well, good evening. Welcome to this live stream on the 10th of March, 2026. It feels as though we've had a full year, even though it's only March. It's Martin North here from Digital Finance Analytics. Thanks for taking out some of your Tuesday evening to spare and with us. Really appreciate it. And going to hopefully have a good conversation this evening about the latest from my surveys, put that in context with regard to what's going on around the oil situation and the broader economic situation, and hopefully shine some light rather than heat. There's a lot of noise. There's a lot of stuff going on. There's a lot of AI slop that is really not helping at the moment. And believe me, there's no AI here. It's all me, and of course the data that I have available at my fingertips through my surveys. Just to remind you, I don't provide specific financial or legal advice. It's a general conversation only. We moderate the chat, but feel free to hear questions, comments, suggestions as we go. And if you use that Walk the World DFA, that'll get my attention, go into my queue. And I've enabled Super Chat if you'd like to make a contribution to what we're doing around here or get your questions on the list. You can use that or support us via Patreon or PayPal. And we really appreciate all those support us via those various channels. It makes a huge difference. We don't do this for profit, just because there's a really important conversation, particularly now. And your help is greatly appreciated. Also, please like and subscribe. Really helps as well with what's going on at the moment, particularly with the way that the YouTube algorithm is working at the moment. It's getting harder and harder to get to break through. So please like, subscribe, and comment. It all helps. And just to acknowledge a few people who've called in. Bob says I should run in, like Tony Barber. I'm not sure that's a good idea. But to Carl this evening, Mr. BTV, Brisbane, hi there. Hello, nice to see you. And Scenario Night, indeed, yes. Scenario Night is what we're going to talk about, apart from other things. And nice to see so many. And as Cookie says, begging for pause or cuts. That's not AI. The cuckoo's on it last night. Did you see? Claiming that we have to cut. But I think it's unlikely given everything we see at the moment. So I thought, hello there. Nice to see you, Nasdaq trader, and saw your comment on some of the other channels the other day. So that's all very good. Let's try and sort of put the show in context. So what I want to talk about is effectively what I call mapping household finances as pressures rise and incomes fall. And that, of course, is in the context of my surveys, but it's also in the context of the markets. I made a show at the weekend, caught in a volatile trap as the war, the jobs and credit risks all hit. There's a lot to talk about there. I think it's worth just reflecting that if you look at the latest, oops, that's the wrong map. Hang on a moment. Let me just switch that back. Go to there, go to there. And if I go there, that should go there. Okay, what's gone on here? Charts is what I want. Yes, there you go. Yeah. So this is the latest chart showing the Brent oil futures. And you can see there that Brent is now ticking around the 92, having reached at one point 115 a little while before that. Obviously, Trump made some comments. We had some other events as well. Crude WTI also dropped back considerably. So that's the sort of the headline move. For those interested, Bitcoin is knocking around 70,000. So it's going in the other way at the moment, interestingly. Markets were a little higher, of course, as well. But the most interesting thing, if you look at the local situation in Australia, is what's happened to bond yields. And it's worth just noting that the 2-year yield spiked yesterday. It's come back a little bit, but it's still at 4.4. Now, that's a forward indicator of where rates are going potentially. And the 10-year is still quite high, but it was touching 5% the other day. But, higher rates means, of course, one thing and one thing only. And that tends to mean that we're going to see interest rates more with an upward trajectory rather than a downward trajectory. The fixed rates are already higher. And Cookie, yeah, nice to see you. Thanks for dropping in. I know you have a horrible early start, but thanks for dropping in tonight. And thanks for all the slides. We're going to use some of them tonight, so check it out on replay. As Jason says, 3:15. Oh, that's a bit early, isn't it? Yes. Did some of that when I was a bit younger, but yeah, not good. Anyway, what I wanted to do was to sort of talk a little bit about some of those contextual issues with regard to what's going on, and then get specifically into my surveys. But let me spend 2 or 3 minutes just on the latest with regard to the uh, externality, right? Because it is, I think, just worth reflecting on things like this. This is actually from the UK, and it shows you how much the expectation about interest rates have changed very, very quickly. And you can see there that at the end of February, they were looking for rate cuts. Last week, small rate cuts. Today, rate rises, and that's continuing. So yes, there's a trajectory which is changing. That's because partly, of course, all of the pressures relating to oil. Oil powers everything. Oil is therefore a proxy for inflation. But it's worth noting, I think, also that if you look at some of the other things that are going on, you can see that other prices are rising: soybean, corn, wheat, and the Bloomberg agricultural subindex already running higher. And that suggests that already some of it is actually baked in. So we are going to see higher inflation. How much higher? For how long, of course, is the big question. In passing, it's worth noting that the Strategic Petroleum Reserve in the US is somewhat down from where it was previously. They let some of it out, and somebody posed the question, Trump, if you were going to do this and you knew what was going to happen to oil prices and oil supplies, why didn't you top up the petroleum reserve first? Which I think is a good question. Of course, in Australia, you've got things like $20 limits, and servos announced fuel rationing according to 2GB. And of course, there are various articles on the petrol holidays and toast prices will be hit. Nobody quite knows how far, how long, but apart from maybe oil price producers, which are enjoying the boom potentially, others less so. And Michelle Bullock spoke, and she effectively said the economic fallout from Iran, who knows? Well, yeah, some would certainly say that we're going to see inflation rising. And, interesting observation. Maybe people will look for ways to save money elsewhere so they can afford petrol. Yes, it's always a pressure. Because, of course, whether you look at cargo, whether you look at other elements too, yeah, it's a significant pressure, and nobody quite knows. Now, of course, Trump did come out and say that he was, concerned about rises in prices, and that was temporary, and they're going to come down. Markets are responding to that, but I'm not sure whether he can actually turn the war off as quickly as perhaps many expect. And as I discussed with Tarek the other day, there are some significant potential fallouts. Fertilizer, as I mentioned, oil prices, and many other things too. And it's worth just, again, highlighting the impact of higher LNG prices, because LNG prices were very, very high, of course, and are still pretty skyward, not quite as high as they were. This is actually the latest LNG. This is the TFF natural gas futures, and you can see there that we shot up to 60, we're back to 48, but still a lot higher than where we were. And it's worth highlighting again, of course, that LNG prices relate not only to the price of literally natural gas, but also to the price of electricity. A lot of companies and countries around the world are using gas to generate electricity, and in the way that the pricing mechanisms works, the LNG is a proxy for price rises in the electricity sector. So you would expect to see higher electricity prices as well following, and that's already booked in. So it is definitely an issue. And coming more specifically to the property market now, it's worth just highlighting. I made a show the other day about the truth and lies about the property market. There's a lot of rubbish being spoken at the moment, and some truth as well. And the latest maybe it's truth. The ABS came out with their estimate of total value of residential dwellings, $12.3 billion, up again. And you can see there that total value of residential dwellings, 11.8. was owned by households. And they showed there that there was significant growth in Queensland, Western Australia and New South Wales. New South Wales just up a little. And I'll just highlight that the number of dwellings rose by 54,000, I should say, to 11,400. And if you just proxy that with the number of households at about 10,000, that tells you that there's about 1.4 million vacant properties or, second homes and things. And the mean residential dwelling rose by $28,000 to 1.074 million over the quarter. Another way of looking at it, across the states, you can see there that in New South Wales, the mean price of residential dwellings, 1.3 million. That's the highest in the country, followed by Queensland, just over $1 million. And Western Australia, all over the $1 million club. Northern Territory was the lowest. But in terms of truth versus lies, again, I showed some of this data with regard to clearance rates. And the true clearance, of course, is a lot lower than the auction results as reported because of the way it's calculated. Christopher came out with the latest clearance rates for Sydney, and he showed that the final clearance was 43.6%. And interestingly, that's the weakest clearance rate for the second week of March since the results began in 2020. So that's a fascinating little insight. Oh, and it's worth just bearing in mind ahead, we've got the anti-money laundering requirements coming in, which means that conveyancers, real estate agents, accountants, and lawyers are going to be significantly hit because of part of their facilitation of commerce, property, and other really important commercial transactions, use of dirty money, etc. They're going to have to do some more checking, and that's going to potentially change the game. Oh, and also, it's worth noting that the latest confidence from ANZ Roy Morgan came out today, fell again. It's the lowest level of confidence of financial conditions over the year. It's pretty much the lowest on record, according to the ANZ economist there. And if you look at the 4-week moving average of consumer confidence by the cohort, pretty much everybody, whether you own a home, paying off a home or are renting, down, and the weekly inflation expectations up to more than 6%. And one other little gem from Shane Oliver, that the Westpac Melbourne Institute survey showed Australian households remain cautious about investing, favouring paying down debt and bank deposits over shares, property and spending. And that's perhaps been like the same for some time. So it's interesting that the trends are suggesting that real estate as a wise place to put investments is a lot lower than it was back in 2012 to 2014. Interesting. And of course, the data also, I made a show the other day about what they don't tell you about household spending, because of course the household spending data is much, much more concerning than the rather filtered stuff from the ABS. As I highlighted, they only looked at certain categories of spending, didn't include things like mortgage payments and those sorts of things, which are big, of course. And it's interesting that the RBA is shifting its conversation away from the wage price index, because the wage price index is very weak, to a broader index, which includes superannuation and also moving from one job to another job as a way of trying to measure what's going on with wages. But the trouble is the wage price index on the RBA doesn't take account of the increased tax which is being taken. So you've got to, when you look at it from a household perspective, you've got to look at the tax, the post-tax story, which is what I do. Oh, and also just, I've made this point before, but I'll make it again because I think it's so important. Household affordability. Interesting, CBA now assumes the dual average full-time income on a household buying a medium price property is still down. Housing affordability down a bit, but you can see it's at 30%, which is pretty bad. And 2 full-time incomes is an assumption which 10 to 20 years ago you'd never have made. It'd be 1 plus a bit. And that all goes back to this, that the actual median price is a lot higher relative to capacity to pay. And this is the sleeping issue. This is the issue that's lying below the surface here, that when you look at it, real incomes are not growing. The pressure on households continue to rise. The costs of getting somewhere to live continues to rise. And it really just become more and more complex for people to try and work out what to do, where to go. And there's almost no information in the public domain about how real households are faring. There are small numbers of 1,000 household surveys that are done, which suggest, like Finder People Do Some, for example, that suggest people are under significant pressure. But actually, there isn't much. But the good news is that you're here tonight because, well, I run a survey. And my survey is, I think, one of the most comprehensive. Now, I would say that, wouldn't I? But been doing it for a long time. Here's the methodology. So we survey households. We put it into our core market model. We have 52,000 households in the data set. So that's a 1% sample over the year. We do it on a rolling basis, and we drop off the oldest each week. We then actually put it into our core market model, and we can slice and dice the data lots of different ways. And that gives us an ability then to look not only at what's happening, but also potentially what may happen through scenarios. And yeah, we're going to talk about scenarios later, and also Louis Christopher's scenarios, which he just republished, by the way. So we take our information about mortgage stress, the price trajectory of property, the buying and selling intentions, the migration data, the other economic data. We put it through the core market model, through our scenarios, and then we can look at it at a postcode level, to a region, a state, and all Australia level. And we can also make some thoughts about where prices may go ahead. Scenarios, not forecasts, scenarios. Oh, and by the way, just forgive the plug, but for those who might be interested, I do provide a one-to-one service. If you're interested in having a conversation about a particular suburb, I can do that. I can't give financial advice, but I can look at my data and talk about the underlying trends. I can look at the stress, the home price trend data, and think about where things may be going ahead. It's an hour conversation via Zoom or phone. There is a cost involved simply because it takes a lot of time and effort to put it all together and make it comprehensible. And if you are interested in having a conversation with me, you can contact me by the DFA blog. If you go down onto the blog, there's a little contact or help button down on the blog there, and you can contact me there. We're booking 3 to 5 weeks ahead at the moment, quite busy, a lot of people wanting to try and understand a bit more about what's going on. But the invite is there if you're interested in having a conversation and do a deep dive. I'm going to publish in the next day or so an example of some work that I did at St Mary's over in Western Sydney, which was a really interesting piece of research that I did, looking at the changes in planning rules and how that actually has changed the price dynamics and a whole bunch of other things. So it's quite interesting to see when you go granular how you get a very different story as to what's going on. Now, of course, we're going to talk about stress tonight, financial stress, mortgage stress, rental stress. It's very important to understand the definition of stress. There are lots of different definitions out there. The one I use is cash flow. Money in, money out. I don't think that a generic 30% of income, whether it's gross or net, is actually that useful. Others use underwriting metrics of various sorts, but I look at in cash flow terms, money in, money out, which means if households have more outgoings, like one-off discretionary items excluded, than income, we define them as stressed. If they have a mortgage, they're in mortgage stress. If renting, they're in rental stress. So I try to take their disposable income and then say, can you keep your head above water or not? If not, then you're defined as stressed. I look at investors with cash flow pressures as well. We can put them into the stressed investor category, and I can aggregate the data to look at the total financial stress at a particular postcode or suburb. I do it at the postcode level because the suburbs are too granular, and based on a 1% sample, you won't get good results. So I look at it at a postcode level. So it's an aggregated level at a postcode. And I can look at it in percentage of households and count. The latter is the best measure, I think, because it tells you the rule of big numbers, but we can look at percentages too. Tonight, we'll look at counts. And the old RBA chart that I keep trotting out really is helpful in terms of understanding the difference between budget pressures, missing payments, and insolvency. Of course, a lot of the financial companies really only report insolvency. And that's the end of a long journey. It can be 3 to 5 years from getting into difficulty with budget pressures through missing payments and insolvency. And some people can claw their way back by refinancing or selling their property. A lot of people are selling actually and getting out and repaying the bank, and that never registers as an insolvent property. But I measure it at the budget pressure end, the mild end, because if you have budget pressures today and you continue to spend the same way, you're going to have more difficulties later. And so that's how I do it. Now, if I look at the results for February 2026 from our surveys, we'll look at rental stress first. So 75%, 75.7%, actually it's gone up again, of those in the rental sector have cash flow pressures. That means that they've got more money going out than they've got ability to earn. And that may well be despite 2 full household incomes going into the household, because I look at a household level. From the mortgage stress perspective, it's still sitting at half. 50% of those with a mortgage, non-occupied mortgage, have a problem. The other 50% are doing okay. And you can see that that's been wobbling around 50% now for quite some time. But we have not seen any drop with the rate cuts that we had earlier in the year. And of course, now we've got a rate rise. So my expectations that mortgage stress will rise from here. The RBA also publishes the debt to income ratio, keeps resetting it and redefining it, and shows it's falling. But of course, that's all households, not just those with a mortgage. And so to make any sense of it, you need to assume that 1/3 of people have a mortgage, so it's 3 times as bad. And in fact, the debt to income ratio for those with a mortgage typically is 5, 6, 7, or even 8 times income. And some new households, newly first-time buyers, are still on 8 times, which is huge. And by the way, it's worth noting that those who have taken advantage of the government 5% means, of course, they've got a bigger mortgage. And that means that the cost of the mortgage is somewhat higher. And in some cases, the banks are still charging a higher interest rate relative to others if they had a bigger deposit. So, yeah, there's more to talk about than just the deposit. It's cash flow. And what I try to get to in my modeling is cash flow. So let's look then at the results. And this is the February 2026 results based at the state level. I've highlighted in yellow where the mortgage stress has gone up compared to last month, or the rental stress, or the investor stress. No investor stress has gone up this month, but overall financial stress. In blue, it's gone down, and when there's no shading, there's no change from last month. And so you can see there that overall mortgage stress still at 50%. That is equivalent to 1.9 million households having difficulties. Rental stress is 75.7%. That's 2.35 million. There's nobody else who publishes regular rental stress data that I see. So this is a really important data point. Stressed investors, 17.5%, that's 522,000 investors with investment properties having cash flow pressures. And the financial stress aggregate, which is the aggregate of all of those weighted across all households, is at 47.9%, which means that 4.7 million out of more than 10 million households have significant cash flow pressures. And you can look at it across the states there, and you can see that it went up in the ACT mortgage stress, went up in New South Wales, went up in Queensland, eased back in some of the other states and territories. Rental stress significantly higher in New South Wales, the Northern Territory, Queensland, South Australia, and Victoria. Came down slightly in Western Australia and Tasmania and in the ACT, but still went up overall. Investor stress dropped slightly, with the 17.5% the same as last time. And financial stress higher in the ACT, New South Wales, Queensland, South Australia, and Victoria. And overall, the grand total up as well. So that's the story. And remember, of course, that this is before we've taken on board the latest interest rate rises. Interest rate rises will come through, and we're probably going to see some more. Nice to see Unifinica, and please like, as MCM says, yeah, it really does help every time you do that. And I think Cookie's now gone, so sleep well, Cookie. So let's continue the conversation and just take the data to the next level. So one of the things that I can do is to look at this across my segments. Now, these cohorts are a way of trying to understand the dynamics, because you cannot take aggregate averages and just say it's X. You've got to understand the moving parts. So, for example, if you look here in mortgage stress, the cohort with the biggest count are on the disadvantaged fringe. So in the areas around our major cities, that includes a lot of new developments and also some older style developments as well. That's more than 500,000. That's the biggest number. If you look at rental stress, the biggest number relates to those in the suburban mainstream category. So, they're your mainstream Australians. Quite a few other people in other segments and cohorts also being hit as well. If you look at stressed investors, again, the suburban mainstream are actually where the biggest counts are. And if you look at overall financial stress, it's in the disadvantaged fringe that we see the biggest But again, it's worth highlighting pretty much all cohorts have some degree of financial stress. So it's not uniformly spread, but neither is it constrained to just one or two segments. If I look at it in percentage terms, it's still the same old story, unfortunately. The young growing family cohort at 89.2% has the highest mortgage stress. A lot of first-time buyers there, a lot of people who've leveraged up to get into the market and even taken advantage of the government's new schemes. And they have cash flow pressures like you would not believe. In the rental sector, this is quite interesting because it used to be that the multicultural establishment group was actually the highest represented in terms of percentages, but actually has been taken now by some of the more mature, stable families, 83.1% compared with 82.5%. And you can see there that wealthy seniors and young affluents are also picked, as well as young growing families. So wherever you are, rental stress is again widely spread. That's not surprising given the rental growth we've seen. Stressed investors, yeah, exclusive professionals and young affluents have the highest percentage because, of course, they have the highest hold of investment properties. And overall financial stress is highest among the battling urban and among young growing families. But other cohorts, including the disadvantaged fringe, are significantly represented too. So you can see that this is a patchwork, and this patchwork is actually quite significant and important. Now, talking of patchworks, of course, we're going to look at some mapping shortly, but I will just show you the data relating to the top postcodes. This is the mortgage stress number. I'm looking at this by count, and I start with Toowoomba at 4350, which is the top of the list, then Wanneroo in Western Australia, Campbelltown in New South Wales, Roxburgh Park in Victoria, Liverpool in New South Wales, Tarneit in Victoria, Camden in New South Wales, Derrimut in Victoria, Point Cook, of course, as well, 3030, Pakenham in Victoria, Berwick and Harkaway in Victoria, Riverston in New South Wales, Narre in Victoria, Cranbourne in Victoria, and Merriwa in Western Australia. And you can see in these Victorian postcodes in particular, you've got a lot of high growth corridors, a lot of new development, a lot of people buying in relatively recently. Tends to be those high growth corridors that really struggle with mortgage stress. And you can see there that the percentages are quite high. There are some where pretty much everybody has a cash flow pressure, and others where it's not everybody, but it's quite badly represented. If I then look at the risk of default, which is my other calculation, this is over the next 12 months, how many people are likely to actually fall over completely. Now, these are small numbers. Remember, the banks tend to extend to pretend and try and protect people from this. But I still think we're going to see Cranbourne in Victoria, Success in Western Australia, and Tarneit in Victoria, and Roxburgh Park in Victoria, right up the top of the list there in terms of the number, not the percentage of the number. And I'll highlight here, we're looking here at 4 and 5 and 3%. So it does vary by percentage. As we go down the list, we see Bundaberg and Toowoomba in Queensland there, and Pacific Pines in Queensland. And in fact, the point I want to highlight here is we're starting to see more and more early signs of those pressures in Queensland because of the very strong price rises that we've had, and because of the difficulty there of households not being able to keep up with the price rises because their incomes have just not grown. So expect defaults, particularly in and around some of those regional areas in Queensland. Rental stress, high in Melbourne, still the centre of Melbourne, postcode 3000, top of the list. Then Toowoomba in Queensland, then Westmead in New South Wales, then Liverpool, then Southport in Queensland, Derrimut in Victoria, Tarneit in Victoria, Zetland in New South Wales and Campbelltown, Ipswich, of course, the regional centre there, Yatala in Queensland, Cranbourne in Victoria, Parramatta in New South Wales, Mount Druitt and Blacktown, top of the list. A lot of counts here up in the 70s and 80s, and more than 14,800 in the centre of Melbourne and 12,900 in Toowoomba. So a big story, a very, very sad story, and unfortunately, not enough coverage in the mainstream about this. If I go to stressed investors, interestingly, Queensland is seeing some significant pressures now with Bundaberg and Southport at the top of the list, then Southbank in Victoria, Derrimut in Victoria, Westmead in New South Wales, Toowoomba in Queensland, Mandurah in Western Australia, Coomera in Queensland, Hornsby in New South Wales, Chatswood in New South Wales, Craignish in Queensland, Baulkham Hills in New South Wales, Campbelltown, New South Wales, and Mother Mountain in Queensland. And you can see there that the percentages, well, they're not flash high, 22, 25, 38% here in the South Bank. But these are still significant counts. And what that means is there is pressure then to sell. And I want to highlight particularly some of these areas in and around Victoria. One of the reasons why property supply in Victoria is continuing to rise is because more property investors are selling and wanting to get out. Now let's look briefly at financial stress, which is the aggregate, because the aggregate, of course, is the combination of all those elements. Toowoomba is at the top of the list. Toowoomba, Queensland postcode 4350, with 57.6% in difficulty, and that translates to 27,700 households out of the 48,100 in that postcode. Very, very significant. Liverpool in New South Wales is next at 2170 with 24,000. Then Campbelltown in New South Wales, 23,800. Then Point Cook and Derrimut in Victoria, 3030 with 23,000. And then Hoppers Crossing in Victoria at 22,000. Then Craigieburn and Donnybrook. And then Cannons Creek and Cranbourne in Victoria. Then back to New South Wales, Westmead and all of those areas. Ipswich, of course, also an issue. Centre of Melbourne there as well. Wanneroo, Western Australia. Mount Druitt in New South Wales. Blacktown in New South Wales. Ballarat in Victoria Regional Centre there. And Camden in New South Wales. So these are big numbers, significant numbers. And, it just highlights the pressure that many are on. Now, it's interesting comment there coming in. Yeah, there is also the question of vacancies. And yeah, there is vacant property around. But of course, in South Bank, for example, and particularly in and around those new developments in the centre of Melbourne, there's a lot of vacant property. A lot of it has not been used ever. So that's another little factor in the calculation. And thanks for that. I appreciate that. Now, is the definition of mortgage stress really accurate? Well, you decide. The question is, if you have cash flow pressures, you are going to absolutely prioritize your mortgage or rental payment. So people don't necessarily give up on paying for their housing. But what they do is they prioritize their housing costs. And what that means is that they have less money to spend on other things. So what I'm seeing quite often is people cutting back on, for example, meals out. Well, that's not too bad. But what about mental and health issues? So we're seeing people actually avoiding some of the things they should be tackling around their health, not going to get their teeth checked, for example, or not actually spending on other things like kids' clothes or schools fees. So look, this is about priority, and paying for where you live is right at the top of the list. So is that the best way to measure mortgage stress? Well, I've argued that it is, because from a cash flow perspective, and anybody who's been in this situation knows, if you have more money going out on a regular basis than you have coming in, you've got problems and you have to actually take steps to deal with it. Now, unfortunately, one of the things that people often do is grab more loans or use buy now, pay later. And what I'm seeing is a compounding of the problem as more people grab more loans to try and get by. And my point is, unless you actually fundamentally change your behavior or deal with the root cause of the issue, it's a problem. Now, of course, people have been working more hours, so we're seeing more multiple jobs, and so trying to get more income in. But unfortunately now, that isn't necessarily sufficient sometimes to cover the cost. So, I will debate with anybody how best to measure this, but I have been measuring this consistently over the last 20-odd years, and it's the trend that tells you just how bad we are and how serious things are. And this trend is unlikely to reverse. Now, Roy Morgan came out and said, well, they think 28% of households are in mortgage stress on their definition. And there are other definitions. And if you look at default in the mortgage book, it's still quite low. But truly, is default the best measure of trying to get at what's going on in their households? Don't think so. And as I say, almost nobody looks at rental stress, which for me is probably the elephant in the room when it comes to all of this, because more and more households have more and more difficulty housing themselves, which is something which I think it's going to be. Yeah, I can talk about percentage of income going on the mortgage, and we'll look at that as we come into the individual postcodes. And you can see that in some cases, we're seeing up 30, 35, 40, or 45% of income going on the But of course, if you've got a big income, then it may not be too much of a worry. But if you have a small income and that is effectively leaving you not very much. So it does depend on the quantum of the mortgage and the quantum of the income as well, which is why I try to do this at a granular level. And yeah, it's very, very significant. And remember, of course, this is post-tax, and taxation is as high as it's been for many people, and it's going to rise higher according to the latest estimates we've seen. Right, let's move the conversation forward, and going to talk a little bit about my mapping. But before I do that, let me just talk a little bit about scenarios, because scenarios are ways of trying to explore the future. And Louis Christopher just published his revised forecast for 2026. It's quite interesting. He goes down to each of the areas and is basically saying that depending on what you think, Perth is looking pretty boomy, and you can see here the various scenarios that they run at 3.85 or going up to 4.1%, or rates rise to 4.5%, or the base case at 4.35%, with inflation at 4.4 to 5 in the June quarter. So Perth significantly up, Brisbane significantly up, Darwin significantly up, Melbourne not so much. So there are minus numbers in all his scenarios, and it gives a range, of course, minus numbers. So he's believing that Melbourne will continue to slide. He also thinks that the scenarios in Sydney is suggesting further slides too. Now, in some of the scenarios, may not be too bad, but here's -9 to -5 or -6 to -2. Adelaide, more growth. Hobart, some growth depending on the scenario. And so the average city weight is slightly positive to more likely negative, depending on the scenario. The aggressive rate rises and somewhere between. So that's his approach. I think it's quite a good one. And he actually goes to places like the Sunshine Coast and the Gold Coast and Arley Beach and Mackay as well. Arley Beach and Mackay as well. So that's quite interesting. So there you go. Now, my scenarios, again, are a way of exploring different futures and to talk about the context. It's not a forecast. It's trying to help to show how sensitivities work, and none of the scenarios may turn out to be right. Things change, and we drive that framework into the core market model, and the scenarios are running. Actually, the scenarios are running from when I ran the model last, which is a couple of weeks ago, so this doesn't include the latest oil crisis, although it's sort of hinted at. And here are my three. So my best, which is, effectively, if things don't go too bad, and if we stay at 3.85%, and we see inflation still above target but comes down a bit later, we have strong migration. I think migration, you've got to take account of what's going to happen to migration. We also get first-time buyer booming. We don't get a recession in Australia, and we start to get wages rising faster than inflation. So that's the best case scenario. My base case is a soft landing where you get a further rate rise to 4.1%, and it holds at that point. Inflation then eases later, in line with they said in 2028. Wages rise, but slower than inflation. But we do get a recession in Australia. Migration falls to about average. And remember, of course, that the latest GDP number was a bit stronger, but actually, if you look at it, it was driven very much by investments in data centers, amongst other things. Worst case scenario is what I call the nightmare scenario. So you see rate rises up, and we see significantly higher rate rises. Inflation steps up, unemployment rises, wages growth stalls. We do get some rate cuts later, but migration drops below the average and we get stagflation. So this is the nightmare scenario. This is closest to what happens if we do have a continued long-term conflict in the Middle East and we have high oil prices, significant pressure on supply chains, all of those things, and we get stagflation. And it's fascinating that the number of mentions about stagflation in Australia and in other countries has gone through the roof if you do a Google search. So stagflation is now very much back in vogue as the most potentially likely scenario, given the Trump intervention in the Middle East and everything that followed from that. So we'll see. And look, those are just ways of showing how things could dynamically play out. But it is quite interesting just understanding the implications of that. And I'll show you a little bit of now my scenario. So this is the all Australian view. And you can see here that we have some growth in the best case scenario across the 3 years. I go out 36 months, so 4.5% over 3 years. the base case is a bit of a fall for houses and a more significant fall in the worst case scenario, which is, showing you if things went absolutely pear-shaped, what could happen. Units follow on pretty closely, so it's pretty close. And, you can pick which scenario you think is most likely, given what we know at the moment. If I look at the ACT, there is a small slide over 3 years in my scenario, a more significant fall in the base case, and the worst case scenario, a more significant fall, down 38%. But again, unlikely, but just to understand what the downside risk could be. It's hard to see upside in the ACT at the moment with everything that's going on. And of course, jobs probably would get trimmed from the public sector in a pressurized scenario. If we look at New South Wales, small rise, 2.9% over 3 years is my base case. The best case scenario, the base case is a bit of a fall, and the worst case, a more significant fall, down a third possibly over 3 years if things went really badly over that period of time. It's unlikely, probably more likely to bounce back, but who knows? And then this shows you the units which fall, but not quite as much, but follow on pretty much. Again, if I look at the Northern Territory scenario, significant rise still. So I agree with Louis. Northern Territory looks like an upside. Baseline pressure is still there, but of course, lower base of prices. In the base case, it's harder to see a rise. And in the worst case, a bit of a fall, down 22% over 3 years. Units following on as well, pretty similarly. If I then look at Queensland prices, yep, a rise is certainly on the cards in the best case scenario, up 7.2%. The base case, small fall, down 8% over 3 years. In the worst case, a fall of 29% over 3 years. And units following on somewhat similarly. And it tends to dive quite so much because there is perhaps more capacity to spend in the unit sector when prices ease. South Australia shows a growth, 9% over best case scenario over 3 years, and the base case a fall, and the worst case a more significant fall. Units following on. Tasmania, hard to see much growth even in the best case scenario, so I'm a bit off where Louis is on that, but interesting to see. But again, worst case a significant fall, and units following on a bit as well. And then Victorian home prices, well, yeah, with the following wind downhill, if everything went really well, maybe over 3 years, a very small rise, but it's unlikely. I think more likely a fall. I've got 13.8% over 3 years, on 35% over 3 years in the worst case scenario, and units following on. And in Western Australia, significant rise still possible, 7.6% over 3 years is my modelling, but a fall of 7.5% in the base case and 28% in the worst case scenario, with some significant falls there too. So that's the story with regard to what we're seeing at the moment. And, none of this is necessarily going to become true, but it shows you some of the sensitivities that we're dealing with at the moment. And I think it's important to understand the dynamics here and to try and understand how these things can play out and what it means when you're actually making decisions. I always say to people, you can't assume home prices will continue to go at the rate they've been going. There were some reasons why home prices were so strong, and that may change ahead as well. So important to understand. Now, talking about mapping, it's worth highlighting. We do map mortgage stress, rental stress, financial stress, defaults, gross investment returns, net investment returns, the net wealth footprint, and the gross debt footprint. All that information is available. I'm not going to be able to go through all of it today, but I will show you some of the maps that relate specifically to the stress modeling that we've done. And, one of the interesting observations here, it shows you that the postcodes are rather different when you actually look at it like that. So let's look at the map. This is the map for New South Wales, and we're starting here in Sydney. And just to sort of orientate you, this is basically looking at the number of households registering as stressed on our definition in the Sydney region, with blue being the lowest counts and the yellows, oranges and reds being the highest counts. Right? So that's the way it works. What we can then do is we can begin to zoom out, and you can see there that as we zoom out, we do start to see some increased counts. Places like Lane Cove and Riverview at 2066 is showing quite significant pressures. And as we pull out further, as always, we can start to see the patchwork being developed. Liverpool stands out with a significant high count. That's in line with what I showed you earlier in the data. Blacktown is there too, 2148. And if we go up to 2765 and other places like that, and then Campbelltown and 2570 as well. So you can see here that there's a lot of pressure in the west, but also some pressure closer into the city. Now, we can, of course, look also in other postcodes. And let's look in and around Melbourne. We'll jump across and look at Melbourne. So again, starting from the center of the city and pulling out, same scale. And you can see here that as we pull out, we start to see the patchwork developing. Now, the yellows are in the 3,000 to 4,000 range, and we can see that they're quite widely spread around the area north, east, and west. But when you actually move out a bit further, you can see there that Wyndham 3029, 3030 is very much part of the problem, 3037. And as we pull out further, the ring of fire starts to show itself to the north, 3064, and also to the west as well. All the places you'd expect. And we pull out further, you can see that, in and around Frankston and Casey, and also Ballarat as well, there are significant counts. So the patchwork is really important to understand here. Not all households in not all areas are actually equally stressed, but there are pockets. Now, traditionally, my expectation is that where these pockets are actually so strong, you would expect to see significant price pressure. And that's certainly what the modelling shows. Right, let's go across and look at Perth. Because Perth, of course, is another country in a way, insofar that in and around the centre of Perth, not too much to see. But again, as you start to pull out Woodlands, 6018, double view, that area there is actually showing some pressure. And as we go out further, we can start to see there are some pockets up towards the north and further to the south as well. 6065, Wanneroo, I mentioned that earlier on, and down to the south as well. And so you can see that as we pull out, we do start to see some areas where there are some significant pressures. And I do think the coastal strip to the north is worth watching. And in the areas around Rockingham, now down there, of course, there's a lot of naval activity and high demand for property. That's changing some of the story down there. But up north, it's not looking that flash. We might go to Brisbane, doing the same thing again. We start with the centre of Brisbane. It's not too bad, but as we pull out, we can start to see some areas where the counts are higher. Camp Hill. Now, the population density in Brisbane is somewhat lower than, say, Sydney, so the distribution is a little bit different. But again, there are pockets where we start to see 4034, for example, to the north, Ipswich 4305. And as we pull out further, start to see that there are some significant pressures. And of course, Toowoomba there, 4350. Down on the Gold Coast, not so high, but there are some yellow pockets there, which shows some pressure. So that gives you a bit of a flavour with regard to the mortgage stress story. Let me now switch and go across to the rental stress. And once again, we're going to start in Sydney. So rental stress in Sydney starts with postcode 2000 and 2010, Darlinghurst. Yes, there are high counts of people there with significant pressure. Waterloo is a particular hotspot, 2017. And then Bondi Beach and places like that are also having significant rental stress pressures. As we pull out further, we can see that Wentworth and places like that, 2145, and Liverpool 2170, Blacktown again on the map. And as we pull out further, you can see that there are considerable pressures. Campbelltown, of course, is showing there as well. And so it goes on. So once again, there is a bit of a correlation between rental stress and mortgage stress, particularly to the west of Sydney. And I mentioned those urban fringe suburbs. Well, a lot of those urban fringe suburbs are over in the west there. We then look to Melbourne. maybe no surprise to see that postcode 3000 is right there in the center with a significant count, more than 10,000. And as we pull out, you can see that the South Yarra area comes up, not quite at the same rate, but significant pressure and high levels of mortgage stress we saw. Now we're seeing rental stress and again some correlation. So the Wyndham area again, 3029, 3030, very high levels of rental stress as well. And as we pull out further, we can see that the rental stress story also starts coming into the north, 3064, and also down to Casey Way, 3977 as well. So you can begin to see some of the story there. And remember that the yellows are still showing quite high numbers, but it's the reds and oranges that really show the pressure. Now, if I go across to Adelaide and have a look there, you can see there that that's Adelaide. Let's go Perth. Sorry, I put Perth in by mistake there. Let's go Perth. Western Australia, Perth. Rental stress, not too bad until you start pulling back a little. And you see a few hot spots, but it's not as severe in the West. And that's partly because income growth in the West has been somewhat stronger relative to other areas. And my observation generally is that in the West, property investors are still doing somewhat better in terms of yields. We'll look at that a bit later, possibly. And you can see there that it's not quite so bad. Now, I said Adelaide, so let's do Adelaide. And in Adelaide, rental stress, again, not too bad, but there are still people with significant pressure. And as we pull out, you can start to see that there are some significant questions to be asked in some areas. But again, nowhere near as high as in Sydney and Melbourne. And if we go to Brisbane, you can also see here that in and around Brisbane, we are starting now to see significant pressure. So 4006, the Bowen Hills, South Brisbane 4101, Highgate Hill, places like that. We have significant pressure. Remember, the population density is lower, so these are quite high counts. And I am seeing, because of this high price-driven environment, with property investors buying in and wanting to let those properties, we are seeing significant pockets. Ipswich, of course, comes up, as you'd expect, possibly. I made this point before. Gold on the Gold Coast as well. You can see there that there are pressures there too. And as we pull out even Toowoomba stands out as a real hotspot, unfortunately, with high levels of rental stress. Incomes are very low, comparatively speaking, in places like Ipswich and Toowoomba. So that's part of the reason. Incomes are a little higher on the Gold Coast. But the truth is that the rents there are much, much higher. And then we might look at the financial stress, which is the aggregate. The aggregate being, of course, a way of thinking about the overall story for households. And again, we'll start in Sydney. And you can see there that the yellows show some degree of pressure. Waterloo, Bondi Beach, Riverview, and up the north there, Lane Cove. There's some areas doing quite well, like Haberfield, for example. But as we go out, you can see there that Liverpool, 2145, Blacktown as well, is beginning to show. And again, the pressure, you can see it pretty well represented here to the west, plus the pockets close in. And I'm quite concerned about 2170 and Campbelltown 2560, as I showed in my earlier modelling. If I then look at Melbourne, at the financial stress level, as you'd expect, centre of Melbourne not looking good. And as we pull out, high levels of pressure and building. So this is a way of trying to get at the overall economic activity. And again, it's pretty sour when you go out towards Wyndham Way, 3029 and 3030. To the north as well, 3064, and also down Casey Way with Frankston there as well, showing it up as well. So you can see these significant hotspots. And if you look carefully, you'll see that listings are up a bit and prices are down a bit in some of these areas. And we might just look at Brisbane. And you can see there that considerable pressure, as you'd expect. Ipswich and the Gold Coast. And we might do Adelaide, which shows some pressure, not as much, but it is rising quite fast, and there are hotspots. Relatively speaking, again, the population density is a lot lower in Adelaide, and that means that even if you've got yellows, that can be quite problematic for some people. So my point with this information is to show you how the patchwork, right? Because the patchwork is a way of trying to get to this question of, well, what precisely is going on, and where are the hotspots, and what does that mean for the dynamics of property? Now, that takes me then to my modeling. And of course, my modeling is a way of looking at a granular level as to what's going on. And the thing about the modeling is it really does get to the heart of understanding the dynamics down at the postcode level. And I did invite people to throw out postcodes before the show. I've got some of those to cover, and I see there are some people asking on the show too, so I'll get to those. Let me just start with the ones that are actually already in the system, as it were. And somebody very conveniently, Mark actually, asked for, oops, let's go there. There we go. Wollongong and Port Kembla, which is lovely because I always feature 2500, don't I? That's one I know really well. And just to give you a bit of a flavour of the way it works, this is the Port Kembla story. The Wollongong story, I should say. This is the Wollongong story based on my analysis. And you can see here that what we have is we have nearly 20,000 households in the area. We have 27% owning outright, 24% borrowing, and 48% renting. So a lot of people renting in the area. We have a lot of rental stress in and around Wollongong, 81%. We have some mortgage stress and overall financial stress at just over 50%, which is high enough to be highlighted here. We have 35% houses and 52% units. We have a vacancy rate that's a little bit up. Now, this was when the census was done. It's probably lower now, but there's no real good, accurate data on vacant property. So I'm using the original census data. It will be updated, of course, when the census is next run. Gross investment yield, which is looking at the relationship between the price of a property and the return that you can get on a gross rental basis. It's a ratio, 3.4%, which is not flash. Net investment yield is taking account of the real cash flow, so money in, money out, all the things you have to do to look after the unit or the apartment or the house, things like agents' fees, things like interest on the mortgage payments and other costs, maintenance, insurance, all of those things. And here it's negative. So actually, on a negative investment basis, net investment yield basis, you're negative. So you're losing money. The data shows that the taxable incomes are 89,000, compared with 84,000 from the census. That gives a disposable monthly. This is a critical number. This is after tax. This is the money that people have available to spend, just over $6,000. And look at this. 41% is going on the typical mortgage at 2,467, and 1/3, it's more than 30% on the old 30% rule of stress, of course, 1/3 going on rental stress at 1,993. Now, the scenarios show that effectively we could be looking at a small rise, 3% in the best case scenario. Base case is a fall of 12%, in the worst case, a third drop. That's for houses. And for units, there's a rise possible in the best case scenario, as I discussed earlier, but the base case, a bit of a fall, and the worst case, a more significant fall too. Now, the other way of looking at this data, and for those who actually provided me with the request beforehand, I was able to do another little bit of information diving. And that's also to look at let's just put that back in, go there. That one. Yep. Okay. So this is now looking at Wollongong's price movement. This is for houses. So this is Wollongong price movements from February 2017 to 26. And you can see there that there were small rises, looking at the scale here down the right-hand side, small rises in 2018, a drop in 2019, a small rise in 2020, a small rise in 2021, a massive rise, nearly 40% in 2022, a fall in 2023, a small rise in 24, a small fall in 25, and a small rise in 26. And that's taken the median house price from 807,000 in February 2017, and now it's 1.2 million in 2026. So that's the story with regard to houses. If I then look at units, and remember there's more units than houses, and look again at the price movements, you can see that there were rises in quite a few years other than 2019, 2023, and 2025. Big rise in 2022 and quite a significant rise in 2026 and 2024 as well. And what that translates to is $556,000 in 2017, the median unit, now $812,000 in 2026. So you would say that in Wollongong, there's more of a rise in units. But of course, you've got to also understand the mix of property, particularly the high-rise developments that have been going on recently, are actually skewing the total picture. So you have to be just a little bit careful when you actually look at this story. So that's the Wollongong story. Let me just look at the Port Kembla story as well. I'll show you this the other way around. So this is the price moves in Port Kembla. And this is for houses because the majority of property in Port Kembla are houses. And you can see that there were very significant rises. Look at the scale there to the right in 2018, in 2020, 21, a massive rise in 2022, a fall in 23, a fall in 24, but massive rise in 25, and more than 12% in 2026. And that's taken the average price from 487,000 back in February 2017 to 973,000 in February 2026. So that shows you that the area, Port Kembla being quite close to Wollongong, of course, is behaving quite differently. So how does that then map through to the other story? Well, let's look at the data for Port Kembla. And you can see the first thing is it's a much smaller household count, so only 2,000. You can see there that more people own their properties outright, that 28% are borrowing and 33% are renting. Mortgage stress is at 30%, rental stress is quite a lot lower at 68%. You can see there that they're mostly houses, 76% houses. See there that the vacancy rate was a little lower than the centre of Wollongong, and the people ratio is above 2, so that's probably couples and families. Gross investment yield's positive at 3.3, but the net investment yield is still negative at minus 0.6. Average taxable according to the ATO was 86,000. To the census, it was 68,000. So there's a bit of a gap there. That translates to a disposable monthly income around $5,000. And again, 46% going on a typical mortgage, more than $2,300. And the typical rent at a third, $1,694 a month going on the typical rent. House price growth, well, there is some, up 4.7% over 3 years, best case, but the base case and the worst case was just falls. Units pretty much following on. So you can see there that it's important to go granular because those two areas are very close and there are some similarities, but also some quite significant differences, particularly with regard to price movements. And I guess that's the sort of the key theme from today's conversation really, is it's really important to go granular and to look at the detail. Now, I keep saying this, but I keep trying to illustrate it through my modeling, that it really is quite important to do that. Now, another request beforehand for Kilara. It was postcode 2071. It's an interesting one, seeing heaps of stuff languishing on the market. Okay, so let's look at Kilara. Firstly, let's look at the price trends. So Kilara shows Bit of a rise in 2018, a fall in 2019, a rise in 2020, more than 30%, a 30% rise in 2022, a much smaller one in 2021, a fall in 23, further rises in 24, 25, and 26, but smaller rises, and only a very small rise in the last year. And that gives you a little interesting story when it comes to the median price in Kalara was 2.4 million in February 2017, and it's now 3.9 million in February 2026. So you can see here, this is a much different price zone relative to the previous one that we looked at. So 2071 is the postcode. If I put that into the analytics tool and bring it up, let's go there and let's go there. There we go. So this is Kalara, obviously in the Ku-ring-gai area up in Sydney. So nearly 5,000 households there. 40% own outright, 36% are mortgaged, and 23% are renting. Only 11% are in mortgage stress. Rental stress, though, is pretty high. And the stressed investors is quite high here too. Overall financial stress, quite a lot lower than we saw in some of the other areas. It's 63% houses, some units. In fact, the units are going up literally and metaphorically. And 2.61, so a lot of families in this area. Vacancy rate was a bit high around the time of the census. It might be lower now. 3.4% was the gross investment yield. But again, net investment yield is negative, and that's one of the reasons why stressed investors are having difficulty. Cash flow pressures are there. Now look at the taxable income, 171,000 for the individual ATO return in 23-24. The census 147,000. So whichever way you look at it, it's pretty high. But the disposable month is around 7,200. That's after tax, of course, and everything else, which gives you a significantly high ratio of 57%, more than 4,000 going on the mortgage, and more than 3,200 going on the typical rent in the area. So very high, very pressurized. There are some rises there in the best case, but of base case or worst case would see significant price falls in the area. So it shows you that it is quite significant and different when you look at individual areas. And that's really the point. You know, you have to go granular, because if you try to read across from, say, Wollongong into Kalara, then you'd potentially be making quite significant mistakes when you actually try and understand what is really going on the ground. Now, I did receive one other request, and this actually came through in the online chat before the show. So I can put that one up. Let me just go back to the other chart. Put it up. Here we go. And this is up in Queensland. Molindanar 4214 from Daryl Andrews. Thanks for the request, Daryl. And let me start with the price data. And you can see here in this particular area, we had rises in 2018, a fall in 2019, a rise in 2020, a rise in 2021, a massive rise in 2022. That's, of course, ultra low interest rates and all the stimulus was actually up 35% or give or take. Down in 2023, up in 2024, up 20%. Smaller rise in 2025 and a 15% rise in 2026. So quite strong growth, typical across Queensland. And that goes from 579,000 back in February 2017, compared with in February 2026, 1,248,000, I should say, in 2026. So a significant rise. And if we then go back to the other data set, let me just put that in. Cut across. And you can see here, we've got 14,000 households in the postcode, 28% only outright, but the borrowing is at 42%. So a lot of mortgage people here, and some renting at 28%. Only a small proportion in rentals, mortgage stress, but rental stress is very high, 89%. Mostly houses, 79%. People ratios high, so that's going to be families again. Vacancy rates low at 4.8%. Gross investment yield is 4.5%. And the net investment yield is just a little bit negative, minus 0.2. Now, I mentioned earlier on, we're seeing more of this up in Queensland, where in fact now the rental returns are going negative. It's unusual, but it's happening now because prices are so high relative to the rental commanding that you can get. The taxable income is about 82,000. The household sensitive 90,000. The multi-flag comes up because that suggests that multiple incomes are going on the mortgage, giving a disposable monthly of just over $6,000, with 39% going on the mortgage and 39% going on the rent, which is not particularly helpful when it comes to trying to get your finances sorted out. And looking at the rates of growth, 5.9%, best case for houses over the next 3 years. Base case, a bit of a fall, and the worst case, a more significant fall. So it does very much depend. So there you go. Those are the ones that came in beforehand. Now I'm going to look down and just see what is going on in the chat and see who's asked for postcodes. And if there are some, we'll try and answer them. Max Freedom asked, how is 6065? Well, let's put 6065 in and have a look. Okay, 6065. So this is Wanneroo. This is the one I mentioned earlier on as being troublesome. 24,000 households, 21% outright. Look at this, 61% of borrowing, 70% of renting. Mortgage stress at 81%, rental stress at 89%, financial stress at 67%, so that's higher than we've seen so far. 92% of houses, and the people ratio is 2.73, so again, a lot of families. Vacancy rate was at 4.6%. Gross investment yield is 3.9. Net investment yield again is negative. Again, I am seeing more of this in terms of the rental pressures now, even in the West. Taxable income, 90,000. Household sensitive, 110,000. The multi-flag comes up. Multiple incomes going on the property mortgage or housing payment. Disposable monthly around 7,600, which gives a 31% mortgage repayment at $2,400 and a 26.1% rental payment at $1,993. And because of this pressure, I'm struggling to see much growth in this particular postcode ahead. There is some demand, but the demand is being offset by all of these pressures on households who've bought already. So my story is there. I don't have the price trend data for this one because the price trend data needs me to run a separate query, which I can't do real time. It takes too long to run. So in future, if you want the price trend information too, get your request in before the show so I can incorporate it like I did with the others. A bit of an observation about West Coast in Australia. Yeah, I don't know. We'll see. Now, time for a new name too. Ask for 5093. 5093 is Paravista and Valley New. Obviously in Adelaide. Here, 3,800 households, a third own outright, 45% of borrowings. So a lot of relatively development properties going on. I suspect they're rental, 23%, 25% mortgage stress, 66% in rental stress. That's a bit high. Overall financial stress on the low side. 90% of houses in the area, 2.4%, 2.4. So again, families, and the vacancy rate was around 5%. And here's the 4.1% gross investment yield. Net investment yield is positive, just 0.1% higher. And average taxable 69,000 compared with 73,000, so it's pretty close there, giving a disposable monthly around $5,500 a month, with 31% going on the mortgage and 29% going on the typical rent. And yep, there is house price growth, maybe 8.7% over 3 years. Best case, base case, a bit of a fall. The worst case, a more significant fall. And the same would be for units in that particular place. Okay. Ryamp asks about Horsham 3400. Okay, Horsham, 6,800 households, 35% owning outright, 30% borrowing, 30% renting, 53% in mortgage stress, 73% in rental stress, overall financial stress at 43%, 88% of houses. People ratio is a bit lower, so maybe some older households or maybe some singles, 8.7% vacant. Gross investment yield 3.1, net investment yield minus 1.9. So a lot of the Horsham areas around there and more broadly across Melbourne are significantly negative from a net investment perspective. Of course, there's also extra tax paid, land tax on investment properties in Victoria, which doesn't help. Average taxable income, $78,000 compared to $67,000 for the census. Disposable monthly, $4,800 with 29% going on the mortgage and 25% going on the rent. And you can see here, I can't see much price growth, even in the best case scenario, small falls or larger falls based on what happens. So that's the story there. Okay, what else have we got? Rose asks for postcode 2358. Let's do that one, 2358. 2358. Should say that this is one around Tamworth with a low count, so be careful. A 1% sample means that there isn't a very big sample coming into this postcode, so just take that on note when you look at it. But nevertheless, a lot of people owning outright, some people borrowing, some people renting, 34% borrowing, 42% owning outright. Some mortgage stress, 57%, a lot of rental stress in the area too, and overall financial stress at 47%. Mostly houses in the area. People ratio is just above 2. The vacancy rate was quite high, maybe some second homes and Airbnb, I don't know, in that area possibly. Gross investment yield is 3.1. Net investment yield is strongly negative, minus 1.5. So a lot of people underwater from a cash flow perspective. Taxable income, $73,000 or $63,000 for the census. That gives a disposable monthly around $4,500 with 34% going on the typical mortgage and 27% going on the typical rent. And I'm not seeing much price growth potential. Maybe the best case, sideways or down a couple of percent over the next 3 years. More significant falls if we get that downside scenarios. And I'll move on. Okay, Shakara said 3029. 3029. How bad is it? 3029. Tarnet. Yep. It's unfortunately a bit of a story. Sorry story here. 41,000 households. 15% owning a right. 55%, more than half, have a mortgage. Ooh, that's high. Renting 29%. 48% in mortgage stress, 87% in rental stress. Overall financial stress is 53.9%. 88% of houses. 306, so these are lots of families in this area, as you'd expect. Vacancy rate was 5.5%. Gross investment yield is 3.3. The net investment yield is negative, again, minus 1.1%. Average taxable, 76,000. Household census at 101,000. The multi-flag comes up, multiple incomes going to pay the mortgage. That gives a disposable monthly around $7,000 with 32% going on the mortgage, 26% going on the rent. And one of the observations about some of these areas, travel costs and getting around, getting into Melbourne is really quite expensive. And that's one of the things I quite often see in these outer suburban areas, the high growth corridors. And yet it's not really very flash, unfortunately. Okay, what else have we got? Mark says, thanks for what you do. Glad to help. It hopefully gives you a perspective. And as with all of these things, Vanessa's dropped in. Hi, Vanessa. Nice to see you. Thanks for dropping in tonight. Really appreciate it. And MCM asks for Kilmore 3764. Okay, so Kilmore is in the Macedon region. I can't say it. Macedon Ranges. Just over 4,000 households there with 32% owning outright, 48% borrowing, 90% renting, 76% in mortgage stress, 71% in rental stress, overall financial stress 53%, 88% of houses. 2.39 is the people ratio, so again, some families. And the gross investment yield is 3.2. The net investment yield is, again, minus 1.4. And again, highlighting the fact that in a lot of these areas in and around Melbourne, people are losing money from an investment perspective. Why? Because, of course, all of the extra tax and charges and everything else, and the limitations on being able to put rents up. Average taxable, 85,000, come over with 83,000 from the census, giving a disposable monthly of just over $5,000, with 35% going on the typical mortgage, just over $2,000, and 29% going on the typical rent at $1,600. And I can't see much price growth in this area, unfortunately, even in the best case scenario. Worst case scenario, more significant falls, if in fact things go pretty bad. Okay. Jake asked for 5171. So this is in the outer Adelaide area, including Pedlar Creek, McLaren Vale. And here, just over 2,500 households, 42% on that right, 43% are borrowing, 14% are renting. There is little mortgage stress, 28%, but a lot of rental stress for those who are renting out that way. And overall financial stress is relatively low at 27%. 89% of houses. People ratios a little higher again, so probably families. Vacancy rate was a little higher as well. Gross investment yield's 4.4. Net investment yield is just negative, minus 0.1%. And I have been noticing that in Adelaide, the capacity to get a return from an investment property from a cash flow perspective is definitely down. 83,000 compared with 78,000 for the household census looking at taxable income. Disposal monthly of around 5,300, 39% going on the mortgage, just over 2,000, and 31%, 1,645 going on the typical rent. And yep, there is still upside potentially in the best case scenario for prices, but in the base case and worst case, not so much. All right, let's see what else we have. NASDAQ trader asked for 2259. Wyong on the Central Coast. Interesting area. There's 25,000 households, a third own outright, 39% of borrowing, 26% of renting, mortgage stress at 38%, rental stress at 84%, and financial stress at 43%. Mostly houses. People ratios on the higher side there, so couples and maybe families. And 3.3% of gross investment yield. Net investment yield is minus 1.4%. And again, I have to underscore, this is significantly the case, particularly around the Central Coast. Average taxable, 81 compared to 79,000 from the two sources there, giving a disposal monthly of around $5,200, with 44% going on the mortgage, 2,340, and 38.6%, just over $2,000 going on the typical rent. And looking at the price moves, well, it's hard to see much growth in the Central Coast in this area, maybe 1.6% over 3 years, but the base and worst cases are significantly below that, of course. So we'll see how it goes. Okay, right. Hongstar asked for 4109. Thank you for asking for that. Appreciate it. 4019, which is Contraff and the Moreton Bay. 9,500 there with 29% earning outright, 32% borrowing, 37% renting, 90% in mortgage stress, 85% in rental stress, and some investor stress too, 67% in financial stress, that's quite high, 70% to houses. And looking at the gross investment yield, it's 4.1%, but again, net investment yield is negative, minus 0.5%. And again, I want to highlight, a lot of properties up in Queensland now are losing money from an investment perspective. Unless you get capital appreciation, which is possible, but, maybe not certain. Taxable income, 83,000 compared with 66,000 for the household census, giving a disposal monthly of around 5,000, with 43% going on the mortgage, $2,000, give or take, and 34.1% going on typical rent. And looking at the price scenarios, I'm struggling to see much growth here in the time ahead, particularly with what I'm seeing with some of this stress information. So we'll see. And here's one. Middio asked for 2122, which is Marsfield, I should say, and Eastwood up in the Ryde area. 12,000 households, 30% on outright, 30% borrowing, 39% renting, a lot of renters there, 44% in mortgage stress, 85% in rental stress. stressed investors are still quite high there as well. And look at 65.5% in financial stress overall. Mostly houses, but other types of their units at 25%, other types of property there too. People ratio is quite high, so there'll be some families. And the gross investment yield is 3.4, but again, the net investment yield is negative, minus 1.3%. Average taxable, 100,000 on the two sources there. Gives a disposal monthly around 5,900, with 50% going on the mortgage, just over $3,000, and 38%, $2,200 going on the typical rent. These are quite high proportions. And I'm seeing this actually in quite a few of those areas. Remember, I showed you on the map that some of those areas up towards North Ryde are actually quite stressed, and this is part of the reason. The costs are somewhat higher, and of course, they also have travel costs as well. Oh, oh no, I mean 4019. Okay, well, we can do that as well. 4019. Good news is I have that. So there you go. I'll just show it there for you so you can cross-check it. And Simon asked for 3844. Yes, I sometimes get things back to front when I type it in quick. This is Tarragon. Okay, 13,000 households there. 34% owning outright, 41% borrowing, 20% renting, 75% in mortgage stress, 74% in rental stress, overall 52% in financial stress, 87% houses there. 2.18 is the people ratio. We're looking at 2.9% gross investment yield and a minus 0.9 for net investment yield. And average taxable 89,000 or 80,000, depending on which way you look at it. That's about $6,000 monthly income, 27% going to the mortgage, 1,589, and 23% going on the typical rent at 1,380. Dear, oh dear. I'm not having much luck, am I? Sorry about that. You did 4019 twice. It was supposed to be 4109. Let me try and get this right. 4109. Sunnybank Hills. Yay, sorry. Oh dear, oh dear. I'm getting tired. I tell you, running a whole show and doing all of this myself, it's a bit taxing on the old brain. There you go. Right, we'll now do this one. Sunnybank Hills, 13,000 households, 36% owning outright, 28% borrowing, 34% renting, 44.1% in mortgage stress, 74% in rental stress, overall 43.2% in financial stress, mostly houses. 2.75% is the people ratio, a lot of families there. 7.2% is the vacancy rate, and 4.4% is the gross investment yield. And yay, positive, plus just 0.2% net investment yield. Average taxable income around 77,000 or 87,000 with the census, and that gives you a multi-flag, giving a disposal monthly around $6,000 with 38.5% going on the mortgage and 34.4% going on the typical rent. I would make the point that if you actually use the 30% rule, there will be a mortgage stress on those calculations too. Yeah, sorry about that. Okay, and Hannah asked for 2582. I'll try and get it in the right order. 2582. Actually, my typing that's the problem. I tend to sometimes put the wrong information in. I have to go back and fix it. Yes, this is what we're looking at here. 5,000 households there, 32% laying outright, 51% borrowing, 16% of renting, 84% in mortgage stress, that's quite high, 75% in rental stress. Overall mortgage and financial stress overall is 57.1% financial stress. 93% houses and 2.44 ratio, so that's people including families, I think. 3.1% gross investment yield. Net investment yield is minus 1.6. So again, another example of people losing money from an investment perspective, other than hoping for capital growth, except looking at my scenarios, I'm not seeing a lot of capital growth, as you can see there. Average taxable, 98,000 or 113,000 from the census. The multi-flag comes up, giving a disposal monthly around $8,000 with 31.4% going on the mortgage, 2520 and 21.7%, 1745 going on the typical rent. Okay. Yeah. No, well, I do think it's important. And the reason I'm doing this is because I want to try and diffuse those high level stories that we're getting from the RBA saying household income's fine, everything's wonderful, or the bank saying there's no default, so there's no pressure. There is pressure out there. The politicians, of course, are not really wanting to talk about this too. Jim keeps talking about the wage growth. Now, when I do my calculations, let me just underscore three things. One, I'm looking at real households here. Two, I'm looking at the impact of all of their expenditure, including tax. And that's the thing that a lot of people are missing here. Taxation is a lot higher than it was. And three, I'm looking at real time because this information is up to the end of February. So this is real, quick time stuff. This is not stuff that was done 3 years ago, like the Hilda data, or it's not stuff that's done from the mortgage-backed security proxies. And of course, everybody says, the mortgage-backs are going to actually be fine. No. There's a lot of pressure. So this is important information that I want to share. And the reason I'm doing this is to try and help people prepare and understand for what's going on. Because the truth is, things are not going that well, particularly, of course, now. And Jason, thank you very much for the super chat. Really appreciate it. Thank you for that. And I also noticed another one from Vanessa. Vanessa, thank you very much for your super chat too. Really, really, really appreciate it. And thank you very much for helping us out there. Makes a huge difference to us being able to do what we do. Now, I did notice Randwick pop up. I will just do that, and then I'm going to close the show and hopefully get out roughly on time. Well, we're pretty much out of time now, but I'll just do the Randwick one, seeing as you asked for that. Okay, Randwick, 14,000 households, 25% earning outright, 26% borrowing, but 48% are renting. 87% in rental stress, a lot of investor stress. That's very significant, I think. And maybe it's to do with some of the students in the area, who knows? Financial stress is pretty high, 83%. Mostly units, 63% there. The vacancy rate was high. Now, when the census was done, the students were away, of course, so that's why it was so high. Gross investment yield is 3.4, but the net investment yield is still negative, minus 0.8. So a lot of people who are letting properties to students are actually not making much money at the moment. Average tax bill is quite high, 142, 130, giving monthly income around 8,700, with 43% going on the mortgage, 3,796, or 33.1, 2,890 going on typical rent. So it's pretty painful. And looking here, I can't see much scenarios on the upside from here. It's more likely to go down, I think. And this stagflation story, yes, it's going to definitely hurt many, I think. And it is very, very much, it's very significant that we're actually, of course, now looking at significant pressure and, of course, significant uncertainty, given what I said earlier on about Trump and oil and all of those things. So as we come to the end of the show, let me just make a couple of quick final points, because I want to leave people not with just a sort of a negative view of the world, but also to say, look, we are in a situation where households need to actually get a grasp on their finances. Only half the households we interview have clear sense of their cash flow, which is a bit worrying, particularly those with some financial pressure. So it's important to do that. And if you do have issues, if you do have financial pressure, you have a mortgage that you are individually servicing, talk to your lender. They are obliged to help. Sometimes they're not very helpful. They sort of suggest you refinance and things or go interest only. That's not necessarily the right solution, but they do have an obligation to help. But also, I want to just draw your attention to the National Debt Helpline, because the National Debt Helpline is by far the best source, 1-800-007-007. If you have debt problems or cash flow problems that you can't cope with yourself, or you're getting into deep, deep difficulty, lots of loans that you're trying to wrestle with, they are the best. And of course, it's government backed. And don't just Google for financial help, because you could actually end up paying for stuff you don't need to pay up. And they always make this point. I want to highlight again. You can actually get some help to avoid illegal action, or be more positive about the future, resolve your financial difficulties, improve your mental well-being, avoid bankruptcy, and very importantly, because this links back to reality, potentially can improve your physical health. Because if you've got financial pressures and worries, then it does lead to relationship breakdown and even stress that leads to physical health issues. So this is important too. There's another tool I want to recommend. I always do. Look at the AFCA statement of financial position. It's there on their website. Gives you a very good tool to put in all of the various categories. What you're earning, what your expenses are, and all those things. That's a really good tool to help yourself, but also if you take it to your lender or help the debt counselor. So I recommend that can be helpful too. Now, I've come to the end of the show. I'm going to very much not be able to do any more postcodes tonight. But if you have a specific postcode that you would like me to share that one-page summary, if you contact me by the DFA blog, I will over the next day or two send it back to you. Please don't give me a long list. I can't do lots, but I can do one. Or if you want to get hold of the complete data set, which is more than 2,000 postcodes, of course, I do actually have that available via my Patreon. Thank you for those who support me via Patreon, by the way. And if you haven't done Patreon, feel free to sign up and give me a little bit of ongoing support. It really does make a huge difference. But particularly the $50 a month tier actually gives you access each month to the more than 2,000 postcodes. I sent it out in the next few days to everybody on the subscription list. And that means you can look at all the information I shared this evening, particularly around the stress and other data, which is quite helpful and useful. So that's available. And I recommend signing up if you want to have a little bit more information about what we do. And if you want to do your own analysis, I have quite a few people who take my information and then do their own modeling. That other information is also made available to lenders and a few other people too, because it is quite interesting. And it's interesting, Bill suggested a marital stress indicator. Yeah, that would be an interesting one to try and do. I'm not quite sure how we'd actually ask that question, but it is very, very interesting. And yeah, glad you appreciate it. Well, thank you for coming on tonight, Jason. Cheers, everybody. Thank you very much. Stay well, and I hope that you have a good week. And let's hope that the oil price drops and we get back to some normal reality. Let's assume that Trump finds a way through this and brings us back to a more stable environment. But my point is, there are things that people need to do to get their finances in order, even more, especially now. Rates are likely to rise higher. Chances are the mortgage rates will go up, and the cost of living and everything else is very, very much, there for so many people. So be cautious, be careful. Be careful about grabbing more loans. I'm really worried by this explosion of personal credit. I'm seeing a lot of people just grab a loan or buy now, pay later, thinking they will get by. This is not necessarily going to get sorted quickly. And so my expectation is that interest rates will be higher, inflation will be higher, cost of living will be higher for the next year or two. That'll put significant pressure on more households who are already in a bad place. So it's important to get your ducks in a row. Thank you very much for spending time with us this evening. The dogs are sort of here. They've sort of expanded. So let me just pull that out slightly so you can, the meteor sort of ran out. There you go. And it is quite funny to see that them laying there and thinking, oh, they're not stuffed, they are real. So when I take them for the walk, I can prove it. But hello, girls. Hello. Now you see, there you go. Anyway, thank you for spending time with us this evening. Take care, and I'll look forward to seeing you next week. And next week, there'll be a conversation specifically about the dynamics of the property market in the context of loan applications and how people are not doing the right thing with regard to applying for a mortgage. So that'll be hopefully a very interesting show, and particularly now with the underwriting standards being changed and some of the other things that are going on in the background, this is a really important conversation. So that'll be what we're going to talk about next week. Take care. We'll see you next time. This is Martin North from Digital Finance Analytics. See you.